You're tuned in to Agriculture Today, and we start our Friday show with a grain market update. And as always, we're joined by K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Thank you, Shelby.
Dan, kicking off our grain market conversation with what are futures looking like?
Well, we've certainly seen downtrends in the major futures contracts that Kansas farmers are paying attention to. We've seen a long-term downtrend since back in November. In right now, our effective lead contract, the May contract, had been up to about $5 and dropped to about 4.10, and then we've seen a little bit of a turn higher from those lows of about 410 or so up to a close yesterday of 429, and some of that probably is the rolling out of the March contract, which is just about defunct. And the volumes show it, just the volume of trade of number of positions in the March contract, minuscule, a small percentage of what they are in the May contract. So when grain elevators give grain elevators, ethanol plants, whoever exporters, when they give grain bits now, they'll be giving their bits basis the May contract for corn. For wheat, of course, we've had quite a long-term downtrend for wheat as well. Most recent one, probably since again mid-late November, about Thanksgiving, had dropped from about 675 down to a low of about 550. And again, also with that contract, again, hard red winter. We're coming out of the March contract, we had so many short positions there, had to buy back out of it, and of that March contract to get into the May. But overall, we've come up now to close yesterday about 587 from those lows about 550, and just that's not a major market rally, but at least it's an interruption of the downtrend. In May, the May soybean contract, strong downtrend began again back in late November, around Thanksgiving. Apparently, we decided to turn the corner and go for the downside. Dropped down to about $11.25. Closed yesterday just a little bit over 11.40. Similar pattern to corn and hard red winter wheat, but not quite as much of an uptick. So again, in all those, we've got just minuscule amounts of volume in the March contract. So we're really now focusing on May, and really, and I think as you and I are talking through this and are looking, we might talk if we have time today about risk management for harvest type contracts. We're look at the volume out in the December contract, and you have a 268 thousand, 5,000 bushel contracts that are traded in D's corn, and that compares to 646 or so thousand for the May contract. So we have volume out there in December, so that's good to know on and when you look at July wheat, about 72,000 for hard red winter, 72,000 5,000 bushel contracts versus May at about 120,000. So again, you have some volume out there, new crop contract. People are starting to think about that. And in November, for soybeans, 119, basically 120,000, 5,000 bushel contracts, and that compares to the May contract at about 345. So, it's worthwhile looking at that. I guess where the volume in these contracts are at, and to keep in mind that predominantly we're still pretty much front loaded. We still have most of our attention now set on the March contract and the May contract. What happens in that will have an impact on the harvest prospects throughout the year. So the market has come to March 1st. And with that, I think our attention, I think we start taking more of a spring mindset instead of a winter mindset. And field work, crop production uncertainty in the U.S. all just around the corner. We've got have a March 8th WASDE report, which will give us more information out of South America. We'll see what the USDA deems is a good forecast for South American corn, soybeans, particularly Brazil, Argentina, and And then at the end of the month, end of March coming up, we'll have a planning, pardon me, a prospective plannings report, and that has the potential to bring a fair amount. Well, that's a nice polite word to say a lot of volatility for the grain markets as we kind of wrestle on this question of whether we'll plant more corn or wheat or grain sorghum or soybean acres here in the U.S. We already planted most of our winter wheat, but spring wheat would still be coming.
And Dan, before we talk about cash flow fast, wanting to really think about, are options something that producers might want to use to manage risk?
Yes, we've fallen far enough that our the prices that we be insuring would be down near some of the crop insurance insured levels, like for PLC, et cetera. For instance, for corn, these corn closed yesterday 463. You look at a 460 put option for about 35 cents. Well, 460 minus the 35 you'd have to pay, you're down to about 425, and that's below the ARC price now. For corn, and I think the PLC price is 401. So we've dropped far enough now on the futures sets of contracts, particularly for D's corn, where if we did go in and buy put options, our price insurance is not that far above even PLC, price loss coverage insurance. So, pardon me, interesting to look at. And I'd say for wheat, again, we closed yesterday for July wheat at let's see, 574, 570 put options, 34 cents. So 570 minus 34, you're about 535, 535. Deal with the broker, you're 534, something like that. And that's just at the futures. And again, we're not far from I believe wheat's 550. So that's a real issue for people to wrestle with. Now we're low enough for that. I guess if we have bushels that aren't farm program related, if we want more upfront control of our coverage, we could go in there and give ourselves some price protection. But we're low enough now to where it compares to some of what the farm program offers. I'd say just quickly then for soybeans, again, November soybeans closed 1133 yesterday at about 1120 is the closest option. 1120 minus the about a 63-cent put option that give you price insurance at about 1060, something like that. And I think that's still sharply above the like 890 thereabouts, 890, $9 for what you'd have for the PLC contract. And so if anything, probably the price coverage and risk management opportunities for soybeans are probably more attractive than the others, because the others are already kind of mired down pretty close to where the other farm program price protections are.
Circling back now, Dan, to what is cash looking like right now?
Cash markets are, of course, they've suffered as the futures have fallen off, and we're back to the days where we're gauging our corn prices off of how close they are to $4. And there was a time when that was $5 and then $6 that we were looking at. Well, now the highest cash corn prices in these different locations that we follow, again, Colby, Salina, Topeka, Garden City, Hutchinson, Columbus, they're all above 4, but there are other elevators offering 399, 380, 385, something like that. Just depends on the elevator and their situation. So highest prices in these areas still above 4. New crop bids are highest in Southwest Kansas. There's a 473 bid, and that's a 10-cent over basis for the that'd be the D's contract. So many others are kind of in lockstep around 438, 443, 423 in different parts of the state. So you have that one demand center, higher bid, and others a little bit lower. Grain sorghum, not too dissimilar. You still have in Salina, Topeka, and Hutchinson, still strong export demand we've seen for grain sorghum, propping up the cash price. And again, a 17 over basis in all those main export locations versus about either 9 or 19 under for corn. So again, grain sorghum has a chance to stand on its own 2 feet when they have this strong Chinese demand for beverages, alcohol within their country. Soybean bids all they all have a 10 in front of them, except in Hutchinson where we get to 1108. So again, far cry different from the 12s and 13s that we've seen for about the last most of the last year or 2 years. New crop bids 10, well, ranging from a low of 1033 out in Colby to a high of 1077 in well, pardon me, 1090 out in the Hutchinson area, 1077, 1073 or so in Salina, Topeka, again, Columbus. It is as it is. And for wheat bids, I don't know how many people still on the farm still have old crop wheat, but their new crop bids, uh, they're over 5 now, and most of them probably have cost reduction numbers goals of over 6. So we're seeing lower wheat bids. Highest bid that I'd seen for new crop pricing is 549 in the Hutchinson area, 539 in Salina and Topeka, closer to 514, 524, 518 in Colby, in the Colby, Garden City, Columbus area. And new crop soybean corn price ratios have generally still favoring soybeans, but not by as much. Again, the decline on the soybean side has taken some of the luster off of soybeans relative to corn. But again, that most of that decision, it'll be a lot of that will be in eastern Kansas, but the bulk of it's in the eastern and central corn belt, that where they're really, you'll have corn versus soybean acres really dominating things.
And as we round out today's conversation, Dan, and as we round out today's conversation, then Dan, a quick update on what exports are looking like.
Really a lot of dynamics. Perhaps part of what also has given some strength to prices is that we've gotten low enough apparently now where world buyers have been able to come in. I didn't say sneak in, come in, and to buy a fair amount of grain at a pretty cheap price, compared to where we're at in it. And for corn, we had averaged about 47, 48 million bushels here in for the week ending February 22nd. Need about 50 to meet the USDA average, and really that's pretty good compared to where we had been. Grain sorghum about 4.95 million bushels on the week ending the 22nd. We need about 4.1 to meet the USDA's projection, so going great guns there. For when you get into the wheat complex, hard red still languishing, but soft red going wild. Really had a week of 10.3 million bushels of hard red spring, pardon me, being exported. Need about 4.75 million bushels to meet their USDA goal, as opposed to where we're at on hard red. Again, just tough Russian, Ukrainian, Black Sea competition for that type of wheat. 1.2 million bushels exported, need about 4 to meet the USDA's projection. So tough there. And soybeans, we exported about 40 and a half million bushels for this most recent week. We have numbers for. Need about 20 to meet the USDA's goal. And we're what window do we have relative to South American availability? That's really the issue. But while we've got this opportunity, we're exporting some soybeans, so that's a good thing.
Dan, I appreciate you taking the time to join us today and give us our grain market update.
Thanks, Shelby. I appreciate it.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now, but stick around because we have more for you ahead.